Welcome to Spidell's California Minute. I'm your host, Catherine Zidane, and this week we're covering some of the tax provisions proposed as part of the federal Build Back Better Act. As part of our annual fundraiser for the Salvation Army, next week we will be doing our $1 per listen drive, so be sure to tune in. And feel free to forward the podcast email to friends and coworkers who may be interested in listening next week or joining the California Minute community. This week, proposed legislation was released regarding corporate and individual tax changes tied to the White House's $3.5 trillion economy recovery bill. The bill, which is going through markups in the House, is called the Build Back Better Act. The first piece of the bill, clocking in at 645 pages, covers tax cuts, including the following. The ARPA changes to the child tax credit, which increased the credit from $2,000 to $3,000 and $3,600 for children under 6, provided for full refundability, and created an advance payment option, would be extended through the end of 2025. Also, the new markets tax credit would be made permanent, as would changes to the child and dependent care credit, and there are proposed changes to the premium tax credit. The bill includes a new payroll tax credit for 50% of the wages paid by an employer to a qualified child caregiver, and a new income tax credit for expenses incurred by caregivers in providing care. Personal casualty losses, which were temporarily suspended by the Tax Cuts and Jobs Act from 2018 through 2025, unless the loss is part of a larger disaster, would be reinstated retroactive to 2018. There are energy provisions, including a tax credit of at least $7,500 for the purchase of a plug-in electric vehicle, plus a $750 credit for an electric bicycle. A separate set of proposals released by the House Ways and Means Committee deals with tax increases. Here are a few of the provisions covered in this 881-page document. The corporate tax rate would shift to a graduated rate, which would increase to 26.5% on corporate income in excess of $5 million. Income between $400,000 and $5 million would retain the 21% tax rate, and income below $400,000 would be taxed at 18%. For individuals, the current 37% top bracket would be increased to 39.6%, which was the top rate in effect prior to the Tax Cuts and Jobs Act, and it would begin at $400,000 in the case of unmarried taxpayers. The legislation also creates a new 3% surtax on modified AGI in excess of $5 million and would be charged against both ordinary income and capital gains. The 3.8% net investment income tax would be expanded for individuals with income in excess of $400,000 if single or $500,000 if married filing jointly, and would essentially make all business income subject to the surtax, even if it was earned by a non-passive investor. Also, the Tax Cuts and Jobs Act limit on excess business losses would be made permanent. At the end of 2021, rather than at the end of 2025, the estate and gift tax exemption amount would return to $5 million per individual. Contributions to an IRA would no longer be allowed once the value of a taxpayer's IRA and defined contribution retirement accounts exceeds $10 million. And last, under current law, if an S corporation converts to a partnership, the corporation is treated as having sold all of its assets for their fair market value, recognizing gain. But the proposal would allow those corporations that elected S status prior to May 13, 1996, to convert to a partnership tax-free in 2022 or 2023. These legislative proposals are a long way from final, though, so the end result could look very different. But as of now, this is what's in the works. We'll keep you posted as more information becomes available. In the meantime, if you're looking for a federal and California tax update, we have a selection of dates and times to choose from, plus you can see which topics we'll be covering at caltax.com under the Webinars tab. That's all for now. Be sure to join us next week for our Salvation Army fundraiser episode of Spidell's California Minute.